Okay, traders. Good afternoon. Here we are, August 30th, Monday. I'm sorry, actually Tuesday, 3:30 p.m. About to embark on workshop session number 5, which got postponed from yesterday, Monday, due to the hurricane. But we are back in action today. Let's pull our screens back up. Had a good day back, getting back in the saddle. You know, sometimes what happens, you'll notice, guys, if you take a vacation for a few days or you're away from screens for a few days, sometimes you come back and you might have a few cobwebs. Got to get back into the groove of things. Perfectly fine. Definitely cause for being more conservative on those types of days, not pushing it. There's never a need to push it. We see some late day short squeezing going on here right now in the markets, as we're about 22, 23 minutes away from the cash close. Got some major short liquidation here. Shorts are getting squeezed out. They just took out the previous level of shorts from earlier this afternoon, coming into some older levels just above the market here as the market comes into the next zone above us here in the 1750 to 1950 range. We're going to update our zones here and update our inventory levels going forward. Going to take the dome down. We're done trading for today. Again, not a super active day, but good day nonetheless. So we're going to put it on the books, close today out. And let's take a look here at our zones, and let's update everything here, and then we're going to go into a little review of what we've covered over the past few days. Last week, the first 4 sessions, since we've had a couple days of a break in between here. Just want to do a quick review, refresh everybody's memory. The videos are all up there except for video number 4. I don't know if Casey told you, but there was an issue with the recording in that video. It only recorded bits and pieces of the video, which was very strange. Every once in a while there's a bug in the video and it doesn't record, and you know, we have videos from previous sessions, and video 4, which would have been video 4 from this session 4, is very similar, if not exactly the same, as video 4 from the previous session, which is up on the website. And while I'm thinking about it, let me just show you where that is real quick. In fact, I'm probably going to add it as a filler into the space where this session number, video 4, would have been. Let me go into the members area here for a second, because this is important. I want to make sure everybody has access to the videos and is familiar with the way that they are set up. Alright, here we go. As we know, we go into the members toolbox. Once you're logged into the site, you see all the videos here. They all have space for an additional video, but this would have been the space here for session 4D. We had an issue with that video, so what I'm going to do is actually copy this link and put session 4C's video down here, but this is the same video. You could just skip from 3D to 4C. Same exact subject material was covered here. Okay, so very important subject, guys. You know, of course, let's do just an update of today's zones first, and then we'll get into a little bit of a review. I don't want to hop around too much here. Okay, we have this zone which was breached after serving as good resistance earlier in the afternoon. Market sold off a good 10 points or so from there, rallied back up. Some more resistance off of this zone, and now they took it up through that zone into the next zone, and now the market is finding resistance in the next zone. That's usually what we see, right? The market goes from zone to zone, just like a pinball. You know, if it bounces off a zone in one direction, too many orders there, too much supply or too much demand, it's going to turn around and head in the other direction. Where does it go? It's going to go back to the previous area of supply or demand imbalance in that area, from zone to zone to zone. Breaks through a zone, acceptance, odds are we're going to see a trip to the following zone, like just occurred. It broke through the zone, had some acceptance, the market took off, imbalance occurred right up to the next zone above. Now, let's split this out right here. Take a look and see if we could pinpoint some wholesale value down here. Let me save everything here. Got a little bit of demand in here. I like to key on this demand, so I'm going to take this zone out. Update that as demand. Still have a little element of demand in here as well, so I'm going to just put a separate zone there, showing what hasn't been breached yet. And we have some imbalance here, guys. You see the obvious imbalance. You know, the market was somewhat balanced here. Not a lot of time spent here or volume. You know, not a lot of acceptance. A little bit of horizontal development. And then all of a sudden, something occurred in the market which caused an imbalance. And this was right around 2 o'clock, right? The news came out. I think the market sold off. Kind of formed horizontally around that area. And then a bunch of demand came into the market to overpower the supply. And the market jumped to the upside. So let's mark these areas right here, this area. We're just going to put one right in the middle, right? It's about 2 points here, 1208, 1206. We'll put one right at 1207. Good to remind us going forward that there is an area of imbalance here. And this overall is a good zone, right? There was a couple of spots where demand kept overcoming supply, right? Right here, the market stopped going down and headed up. Right here, the market stopped going down, headed up, so we know demand, and then here the market took off in a hurry. Very little trading. And as the market took off to the upside, it's obvious that there was a demand imbalance here. Now, as we're on our chart depicting the zones, our market map, let's just review a couple of our key concepts here as far as zones go. The 3 important things that we take from our zones, from our zone charts, our profile charts. Number 1, the zones themselves. Right? Where is the wholesale value? Where is the retail value in the market? Number 2, these areas of imbalance, as represented by these dashed lines. And number 3, acceptance and rejection. Enables us to see how the market is developing. As the market's probing to the upside here, it's getting accepted. Value comes up to meet price. Price probes up, it gets accepted. Value comes up to meet price. Price probes up, gets rejected, back down into value, now breaks below value, and we get a transition. Now the whole process repeats itself to the downside. Right? Everybody familiar with those 3 key concepts about the profile chart? And that's it. You know, I mean, market profile doesn't have to be complicated like people make it out to be. We're not paying attention to any other information there, guys. We're just focusing in on the little bit of information that we deem to be important to quantify previous areas of supply and demand, right? We're trying to quantify where the orders were previously. Where were the buy orders in the market? Where were the sell orders in the market? This identifies our playing field, and by looking at this chart and keying in on these zones that we have identified, we're able to immediately focus in on the important areas in the market. And you see every day, day in, day out, how the market truly responds at these levels. You know, in the beginning you might have thought it was a coincidence, but by now hopefully you've come to the realization that these zones are for real, guys. There's a reason why We put them where we put them, how we identify them. There's a reason why they work. They represent previous areas of supply and demand imbalance. That's what it comes down to. As order flow traders, we're trying to key in on those areas of imbalance. Imbalance equals opportunity. If anybody needs any clarification on that or any of these zones from today, please let me know. We could also put a zone in here. Let's do this. Let's split this out right here. You see these two zones. This one's kind of overlapping this one, so let's merge this into here. And just identify a nice little area of horizontal development in here. Again, is this my most favorite zone? No. Does it have the highest probability attached to it? No, definitely not. But it's a demand zone nonetheless. Very clear where the horizontal development was. It's very clear that demand overcame supply within this area, right? Because the market's now higher, and we see the imbalance right here that took it out of here, right? So we can actually identify that now too. Right here, right? Single prints, unfinished business. Everybody comfortable with looking at these charts? Is there any issues with any of these particular aspects of these charts that we just talked about? The unfinished business, does everybody understand what that unfinished business represents? The imbalance that took place there? The mechanics of using the program as far as splitting and merging these zones, is everybody familiar with that? How we right click on the profile, wherever you want to split it, that's where you're going to right click, hit split. If you want to merge two profiles, you click on the profile that you want to merge. It doesn't really matter. You can merge to the left or you can merge it to the right, either way, but you're going to right click and either merge with prior or merge with next profile. If you make a mistake and you want to undo a split, you can click on this, undo all splits, it will bring it all back together again. If you merge two profiles and you decide, hey, you know what, I'm not crazy about that merge, you could right click and hit undo all merges in this profile. You can be careful about hitting this one or this one, because this one is going to do it for the whole chart. Undo all splits for the chart, undo all merges for the chart. You don't want to do that. You just want to do the specific profile that you're working on. So that's what I would expect everybody to be doing by now, to be comfortable splitting and merging. Perhaps at the point where you're starting to develop your own market map every night, compare it to the market map that I post in our chat room every morning at around 9 a.m. And that's the main purpose why I post that market map there, guys. It's not really for you to refer back to during the day, although you can. It's just so you could check your profile and compare your market map to my market map. There's always going to be little discrepancies, because I might split something a little bit further than you split it. I might merge where you don't merge, or you might split something a little bit further than me. It's not wrong to split a little bit further. It just means you're developing a little bit of a tighter profile versus leaving a profile altogether, which will give you a bigger zone. Either way, you're still pointing out value. It's just that in one case, if the profile is unsplit, it's going to be a higher time frame, right? So the zone's going to be a little bit higher. So you're showing value that took place on a higher time frame. If you split it out, now you're going to be looking at several profiles of lower time frames, right? So you're going to show tighter areas in most cases of value. There's no right or wrong. It's a matter of just playing around, splitting out, seeing if the picture becomes clearer to you. See if you could find the spot where the market indeed turned around, where that demand came in. If not, just merge it back in again. No big deal. This is a never-ending, ongoing process for us as far as reviewing everything, but especially the zones. You know, the zones is something that you're going to see my market map every morning. Once we get back together at 11 a.m. into the members only trade room, we're going to redo the zones at that point, update all the zones. We update them throughout the day. So it's an ongoing process. So don't get anxious if you don't understand it just yet. It's going to become more comfortable to you. And remember how you felt. I mean, everybody, think back 2 weeks, or for you older students, think back a month when you first started, or 6 weeks ago when you first saw these zones. I'm sure many of you had trepidation, you know, and the whole concept of how we use the zones must have been really uncomfortable. But by now, all right, you might not be a professional yet in using the zones. We don't expect you to be, but at least they're going to be a little bit more comfortable now. You know, you realize it's different, but you're beginning to embrace just how valuable these zones are, you know, and how accurate they are in providing reactions in the market. And again, not accurate as far as to the tick. We're not really concerned with to the tick, but accurate as far as providing us with zones of price where we feel the market's going to react with some degree of probability, especially when we have order flow confirming. Okay, so that's the zones, and that's one of our two core principles that form our edge, right? Determining where these zones are. Number two, reading the order flow. Let's get rid of this tick. We don't need this tick anymore. Now, we talked about some really important stuff last Wednesday and Thursday when we started to delve into the order flow. We talked about some different situations that we see on our charts, right? We talked about divergence, what that represents to us. We talked about how divergence represents commitment, right? When we see divergence in the inventory, what it's showing us is commitment of the smarter money traders, right? Will you only be able to compare your chart with us if you have a DTN feed? Well, as far as the zones, there shouldn't be much difference in the zones. The zones, and as far as the market profile charts, they should be very, very similar. There should not be that much of a difference there at all. That's really based on overall volume. It's not really based on the parsed volume. And when I say parsed volume, I mean, you know, these order flow studies are based on, it splits the volume up, what volume is taking place on the bid and what volume is taking place on the offer. So for the profile charts, we're not really looking at volume that took place on the bid or the offer. We're looking at where overall volume took place. So those should be pretty much the same. I've never really noticed much of a difference either way comparing different feeds. But as far as the inventory, there's going to be some discrepancies only because DTN is highly accurate in how it reports trades as compared to some of the other data feeds, especially the free data feeds from, you know, the brokers, the OEC and Transact. And what it comes down to is if a trade goes off on a bid, it's still reporting the same price, the right price, but it might report a trade that went off on the bid as going off on the offer. And that's going to skew the order flow, whereas DTN is going to show it as a sell going off on the bid. Another data feed might show it off as a buy going off on the offer. So that's a discrepancy. Now, that being said, we have traders that are using other data feeds, and they see some discrepancies in certain times of the day when the volume picks up. For the most part, it's pretty close. It's pretty close. So for training purposes, I think it's perfectly fine because you're not really getting into the intricacies. But I think once you make the leap and you start trading an account, that you should really go for the DTN IQ. They'll provide you with a free trial as well. And you'll always have access to my charts as well to compare. So we talked about the divergence and what it means to us when we see that divergence in the market. Um, Hold on 1 second, guys. Okay, so the divergence, showing us the commitment of the smart money when we have price making a higher high and maybe order flow isn't making that higher high. Right now, there is no divergence. Right, as price is making a high, we're talking about what we're seeing right here on the longer time frame. We actually have divergence, but what we see right here in front of us, we really see no sign of short commitment here. Right, as price came up back in their face here, where they got short earlier in the day, they were liquidating their position, so there was zero commitment there. Now on a higher time frame, let's see if we could show where this divergence is in effect. You see this level here, guys? This level from August 18th, this level from August 17th represents short inventory that was put on here and here. Now this level is right here, which you see price getting above right now. These lines are so hard to draw straight sometimes. And then we have inventory that was put on at this point on the 18th, and that's way underwater, right? They're taking heat. Those positions were put on below 1200 and 1190s, and here we are 1213, and we could see that these guys is still an element of inventory trying to hold on. Not much, most of it was just squeezed out on the close, but small element. But there's a big element of inventory committed from these levels. Right, so on a longer time frame, we do see shorts trying to stay committed. As far as the shorter time frame and on the time frames that we trade, we don't see much in the way of commitment here just yet. But we do see this inventory transition. And remember earlier, I talked about my next area of interest would have been the market coming up and getting right in between these two levels. Right? We talked about how the combination of this level and this level would provide us with a good area to cycle inventory in and out. And unfortunately, it didn't happen till late in the day, too late for us to take advantage of. But, we laid that scenario out ahead of time, right? We were looking for that inventory transition to occur. Now it's a matter of watching what zone it's getting into, or to confirm it's getting into a zone while it's occurring. Now we have the synergy of these two different aspects of our methodology coming together. And guys, I don't expect you to understand that 100% just yet. I think it's still important for you to concentrate on things separately. Concentrate on just the zones, understand where they are. I want you to start understanding why I'm putting a zone in a certain place, and then look at the inventory levels. I want you to start noticing how the market reacts at these points. Start to notice and recognize when I'm speaking about these areas, what we expect to happen there. It might happen half an hour down the road. It might happen 3 hours down the road. But as long as you're understanding on an individual basis what occurred here, that's fine. That's all I want you to get at this point. As time goes on, we get deeper into this week, next week, it's going to start coming together even on a deeper level as far as the synergy. Looking for a zone. Okay, it's near a zone now. Now we're looking at our inventory. Is it about to take out a level? Has it just taken out a level? Is there divergence in the buy pressure, sell pressure? These are things that are going to start to build and form opportunity. And you're going to start to recognize this stuff pretty quickly on a very visual basis without much thinking. That's what occurs down the road. For now, you're still breaking stuff up into individual aspects and making sense of it. So back to the order flow. We talked about divergence. The other important thing that we're looking at here are these inventory transition events. What happens when an important area of inventory gets neutralized? Okay, in other words, we had short inventory that was put on here We had short inventory that was put on up here. They didn't quite get up to this level. They almost got up to it. But as these groups of shorts were taken out of the market, right, they were getting squeezed. They were causing demand to come into the market. They were buying, 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 forcing price up above themselves, up against themselves, right? They're actually, it's really funny, but they're the ones that are actually causing price to come back on themselves because they're the ones that are doing most of the buying, right? They're getting nervous. They don't want to be in the market anymore. As they buy, they're causing the demand that's causing price to go higher in their face and give themselves heat. It gets to a point where they can't take it anymore and they get out. We have this mass capitulation. After that capitulation occurs, we get that vacuum, right? Demand temporarily diminishes. There's no more demand. Everybody that was buying in here is done buying. There's no more shorts to buy to get out. So now we expect the market to fall back in on itself like it's doing right now. Very normal. I mean, do we look at this and say, hey, you know what? We know that we're going to get an 8-point sell-off. No, we don't predict. We never know anything like that. What we're looking for is a reaction there, right? With a high degree of probability. And that's what we got. This happens to be a really nice reaction, but this is the type of reaction that we see. And it's no coincidence, guys. This zone was here. We saw it. Came into the zone as this condition and order flow was taking place. You'll see different variations of different steps in the order flow that I take as far as when I take a trade. Different conditions that I like to see set up. Sometimes I'll be more aggressive and I like more confirmation. Other times I'll start to probe a little bit. And ultimately you'll get to that level. I don't expect you to understand every trade I'm doing at this point. A lot of the trades are going by pretty quick. We try to talk about all of the zones ahead of time. So that's the most important part. I don't expect you to understand exactly where and when I got in. Let's say I got short in here, which I didn't, but let's say I got short here at 12.18.25. I don't want you to sit there and try and overanalyze, well, why did he get in at that price? That's not the important thing right now. The important thing is to recognize, think about this as a zone. I understand why he was interested in a short here. Now I understand it to a higher degree of probability why he was interested because of what occurred here in the order flow. That's what I want you to understand. I don't want you to think too much about why did he execute right there? Why did he take profit right there? How far is this move going? You're getting too far ahead of yourselves if you're thinking like that. I'm talking about the newer students. Just break it down. Understand why I was interested in here and what happened in the order flow. Think about it, guys. This is your foundation. You can't get too far ahead of yourselves. Build the foundation, and there's going to be plenty of time for you to trade and put it all together and make money. But if you don't have a solid foundation, it's all going to crumble. So it's important that we understand things and we break things down. I know sometimes it could seem repetitive and maybe monotonous at times. I don't know, but it's important that we talk about these things inside and out till we're blue in our face sometimes, because that's how you learn. Repetition is the mother of skill. And it's the simple things that matter the most, especially with a methodology that's as simple as ours is. On the face, someone just coming into the trade room, think back to the day when you first came in and saw me trade, probably seemed pretty confusing to you. I think it probably made sense on some level that, hey, this guy's got an edge. It makes sense, supply and demand, let me learn more, but everything else is probably a blur to you. But think about how far you've come in a few weeks. And think about how much farther off you're going to be down the road 2 weeks from now. It's a process. Just keep your patience about you, and you're going to get there. Everybody does. So, divergence, which we didn't have here, and inventory transition, two very important things that we're delving from these charts, guys. Now, smaller time frame, here's how I like to recommend you just try and absorb this initially. Okay, understand the zones. Understand step one is we're always looking at where my nearest zone is. If I don't have a zone, or I'm not in close proximity to a zone, I'm not going to be interested in the trade. Okay, so know where your zone is. Number two, we're looking at, for the most part, we're going to concentrate on inventory transition points on the higher time frame on this chart. And we're going to pay more attention to divergence on the smaller time frame chart, because these divergences that are occurring sometimes on this higher time frame chart, like the one I just showed you from August 18th, sometimes those divergences are happening on a scale that's too big for us as day traders to take advantage of. They're good to begin to recognize, down the road. I wouldn't even waste too much time right now thinking about it on such a higher time frame, because it's just too big of a time frame for you and I to trade on. We're not looking to hold trades overnight. We're not looking to hold trades for days at a time. So the divergences, we're going to pay more attention to these types of shorter divergences. We had a very, very minor one right here. This is a good example, guys. All right, you see this price level is indexed to this inventory level. All right, look at how price came all the way back to the exact swing point. And again, I say exact, we don't care if it comes exact. I don't care if it's a little bit above or a little bit below, but it came back to the price level. But yet, look at order flow. We could see there's a grouping of contracts here that stayed committed to the buy side. Right? And it's not really important the exact number, but I'll tell you there's around 10,000 contracts or so that stayed committed. This is divergence. If this is occurring, and it's hard to tell right now because we've erased zones, and this is after the fact, but if this is occurring as the market's coming down into a zone, it sets up a very high probability opportunity for us. Right? Because the market's coming into a previous area where demand overcame supply. At the same time, we have new traders that got into the market recently, and they're staying committed to their positions. So it's going to be hard. I'm not going to say it's going to be impossible, but it's going to be hard for the market to get through that zone if a zone was there at that time. Does that make sense to everybody? If it doesn't, please let me know. So that's a good example of a shorter time frame divergence. So we're going to pay attention to these major inventory levels, because we could trade off of these levels too, but it's a little bit, I'm not going to say advanced or complicated, but it's easier if we just key in on the major inventory levels for now, and then ease into these inventory levels that are occurring, because these are minor levels. But you're going to get to a point where, all right, you see a minor inventory transition occur. The market's coming into a buy zone, a demand zone. You see divergence in the sell pressure. It's going to equate to a good opportunity. A scalping opportunity, but still a good opportunity where if you're nimble and quick on the execution, you can get in and get out and book your profit. And those are the type of trades that I think you're going to develop into. We also talked about the three signatures that were occurring within the every inventory transition. Right? We talked about the capitulation. We talked about the smart money. Now let's find an example here of an inventory transition. Actually, this is actually a good example where, we have our capitulation. All right, shorts getting squeezed. See this? Pretty aggressive up bar here in order flow. This is capitulation. These guys, they want to buy. They need to get out. They don't want to take heat anymore. They don't want to be in this position. Look at the intense up move that was created there by the capitulation. It's an area of imbalance, right? Because there's a lot of demand coming in. And where's that demand coming from? From stops getting hit. So it's demand, but it's coming from losing traders. And as soon as that demand peters out, no more real demand up here. In other words, there's not a lot of people interested in getting long up here. So the market can't stay up here on its own. It falls back in. All right, so capitulation, step one. Step two, smart money takes profit when they see that capitulation. and they take profit into that capitulation from any longs that were put on down here, right? Step 1, capitulation. Step 2, smart money taking profit. Step 3, smart money initiating short positions in the other direction, right? Those are the 3 signatures that we see over and over again in the order flow. Let me show you that transition as it occurred here on this chart. And you don't need to see this every time, but you know that this is what's occurring, right? This is the capitulation. All right, remember, this is buy pressure. These are trades going off on the offer. These are buys. And these are sells going off on the bid. Look at the buying pick up in here and how one-sided it was right here. You see this yellow line? This is showing us the difference between buys and sells, right? So there was a lot of buying coming in here. A lot of guys started to buy. They didn't want to be short anymore. Now you start to see some selling come in here. Once the big buying, the capitulation starts, the smart money senses that. They sense the blood in the streets, right? So they start to take profit on their long positions from below. And what do they have to do? They have to sell, right? So you have shorts buying to get out of their losing trades. You have smart money longs who have to sell, right? So they're selling to the shorts who have to be buying to get out of their trades. They need that liquidity, the smart money. That's why they're pushing for the stops. Now you see the transition occur here if you follow this yellow line from buy pressure, buy pressure, buy pressure. Now some sell pressure coming in. Now notice what happens here. Now it goes to all sell pressure. And basically the same thing happens to the downside, right? Smart money that got short up here starts to buy once they see this capitulation taking place from longs that are trapped down in here, right? Look at this, guys. Right here. Perfect. So we actually had an inventory transition followed by another inventory transition to the other side. Right? All these longs, late to the party longs, right? And why do we say late to the party? Well, this market's rallied, what, 90 points roughly in the last 3 trading days. And you got guys buying all the way up here. The rally started around 11:30. You got guys buying 12:10s. Those guys are late to the party. You know, if they're swing trading. Scalping, different story. But if there's guys buying 12:10s and hoping for 12:30s, well, you know what? Guess what? You're late to the party. You're going to get squeezed. And they just got squeezed out on the close here. Well, 4 minutes to go on the close anyway. Same thing that occurred at the other end is happening down here now. You see all the sell pressure. Amazing amount of short of long inventory just getting squeezed out there. You know, probably a good spot for an after hours pop in the market. Because now the sell pressure's kind of dried out here. As we're coming into a zone. Right? Coming into this area of unfinished business and into a demand zone. See how the market wants to rotate through here, guys? Comes down into the area of unfinished business, pops up, rotates down again, pops up, rotates down again, pops up, right? It wants to rotate and fill out this area. It wants to trade throughout here and fill in the unfinished business. But in the same token, it's given many good rotations in here for scalping, right? These rotations are all 1.5, 2 points wide. You know, every bar is at least 1.5 points here, if not 2 points. And every bar is like rotating down and then rotating back up. Rotating down and then back up again. A lot of good rotational activity in there as the inventory transition's occurring, as the market is getting into this zone. It's like the green light for long trades goes on. You know, this is an area we say, okay, you know what? I'm going to put my sign out. I'm going to start doing business here to the long side. And again, we're taking it out of context. It's the end of the day. We're not going to be looking to trade here at the end of the day. But this could be happening at any time of the day. It just so happens that right now is the close. If If that doesn't make sense to anybody, please let me know. Now, that was just wanted to do a review, guys, because I feel like we've had a couple days in between the last time we talked about this stuff. One other thing real important, the fact that 80 to 90% of market movement is caused by losers liquidating their trades. I just want to make sure that makes sense to everybody. If anybody has any questions on that, please let me know. It's so important. You know, if most traders have a large portion of losing trades as their particular results over time, it follows that a lot of what is causing price change is losing traders liquidating their trades. Right? So that's what the market is constantly doing. It's in the motion of squeezing out shorts. No more shorts to get squeezed out, no more demand. Let's go squeeze some longs. Squeeze out the longs, no more longs to be squeezed out. Okay? Let's see if some demand comes in here now, and we'll go back and squeeze the shorts. If not, we'll go down and squeeze some more longs. The market is in that mode constantly. All right, today, guys, I wanted to talk a little bit about the tick and the breath. Okay, so let's bring up a chart of the tick. So there's no questions on any of that stuff, right, guys? And if there is any time, please let me know. Watch those videos again. Very important stuff. And some lights are going to go on, guys. You know, if you didn't have an aha moment the first time hearing it, watch those videos again. Watch them a third time. It's going to click with you. I could tell you that it's one of my most important aha moments in my trading career. Was when I really fully, it hit me, you know, when I really fully understood what was occurring when these inventory transitions occurred, and not only that, but where these inventory transitions were occurring, the location in the market, in my zones. Powerful, empowering stuff, guys, that really, truly stacks the odds in your favor. Let me just update these zones. I don't like having fully breached zones in front of me. Alright, that'll be good for now. Alright, let's talk about the tick, guys. And you know, the S&P futures, in my opinion, I mean, it's, as far as a single market, it's my favorite single market to trade. I mean, overall, I love trading the Forex markets as well, but that's collectively, you're talking about a lot of different markets, different currencies that make up the Forex market. The S&P futures is definitely my favorite single market to trade. You know, it's very stable, lots of liquidity, lots of commercial participation. And the more commercial participation we have in a market, the better for using our inventory studies, you know, as a proxy to track the ongoing open interest that's occurring in the market. But another thing about the ES that I like is the fact that we could clue into what the cash market is doing. And when the cash sessions are open and they're trading, we need to follow the buy and sell program activity in the cash market as we're trading the futures market. It gives us an extra bit of information. And again, it's not so much that I'm ever using tick to keep me out of a trade. It's more a matter of, I get into a trade, is the tick supporting my trade? If I just got long, well, I don't want to see continued pressure to the sell side. I don't want to see continued sell program after sell program. If I just got long, I want to see something like this. I want to see at least a transition from selling activity into buying activity. You know, and if I don't see that type of buy response in the cash market, yeah, I want to see a buy response in the futures too, but if I don't see any type of buy response in the cash market, I'm going to be that much quicker to start to take some inventory off. Depending on the situation, maybe even get completely flat, depending. But if I'm not seeing what I want to see, when I get into a market, if I get into a trade, I get long in a zone. Two things that I want to see: buy response in the futures and a buy response in the equities market. Sometimes you only get one without the other. You know, the more of a buy response you have overall, the more confirmation you have that your trade is a good trade and to maybe hold on for a few more ticks. Doesn't mean the market can't react. Like, it doesn't mean if there's a buy response in futures at a zone, the market can't react a few ticks up, and yet sell pressure is still occurring in the tick. That could happen. But that's more reason for taking those few ticks real quick and booking them, right? Because you're not seeing that buy response yet in the tick. Does that make sense, guys? It's not complicated. It's not, you know, looking at the tick. People, another thing with tick, you know, it's another thing that traders make it more complicated than it has to be. It's not complicated. We're not sitting here staring at every up and down bar because you'll go crazy. You know, we put the white line on here, first of all, to show us, hey, where has the pressure been for the last half hour? Where's it been for the last hour? Well, it's been steadily to the buy side. We're starting to see a transition to the sell side. This is good if you're working short trades. You've seen this transition occur. You know, you get long, you want to start to see, if you're holding on to runners, you're going to start to see a transition to the buy side. You know, and if a lot of times we see these battles where the market will race up to a supply zone, and you could tell there's commitment from short traders in the futures. They're trying to stay committed, but yet the market kind of stops there. But yet we'll see buy programs still going off. Cash markets still running buy programs, pressuring that short inventory in the futures. But yet the short inventory, they're trying to stay committed. And maybe even you get a few nice couple point rotations down here and there. But for the most part, the pressure is still staying to the buy side. Well, then you got to be careful with shorts there now. Because odds are, cash market, the majority of the time, the cash market is going to win out. You know, it's a much bigger market than the futures. They're going to win out. And we see that time and time again. So when the cash session is open, it really pays to be following that activity there. And realize that when the cash session is trading, and it starts trading at 9:30, the U.S. equity market, the ES is frequently going to follow the equities buy and sell program. Right, and to a certain degree overnight, if you guys that are trading a little bit earlier in the morning, the S&P futures will actually follow what the Eurozone equity markets are doing. It's not going to be as intense, or as they're not going to have as much influence as the U.S. cash market does on the S&P futures, but they are going to at least take a little bit of a lead from the EU markets, the cash markets, the equity markets, up to a point where a significant inventory transition occurs. Right, when an inventory transition occurs, then for that moment in time, the futures are going to be in control, because you have some incredible dynamics occurring beneath the surface. You have some incredible changes in the dynamics where 1 second is a lot of buying, right? All those shorts are taken out, no more buying. You get that vacuum. Well, that's a big change in the dynamics. That change is going to at least temporarily affect the cash market if the cash market is open. So those are pretty much the few times during the day where the futures market will take the lead, is when we have an inventory transition event. At that point, when we're having that event, I'm actually paying very little attention here to the cash market, because think about this. And I think we had this question in here a couple weeks ago. When we see an inventory transition, what are we most likely going to see here in the cash market? And think about this. You're going to see this capitulation occurring, right, in the futures. So what is most likely forcing this capitulation? The cash market running some intense buy programs. Right? So right up to the point, and maybe shortly thereafter that inventory transition occurs, you're going to see some impressive buy pressure because they have to put the pressure to the buy side in order to squeeze out the shorts in the futures. So at that point, once that transition occurs, you might still see pressure in the tick, and that's why I say I'm not going to let the tick ever keep me out of a trade. It's more a thing that I get into a trade and I'm looking at for guidance, because you're going to still see some buy programs there because they're trying to squeeze the shorts out here. The only way they could do that is by running buy programs. So it's these buy programs that are actually causing and prodding that inventory transition to occur. Right? They know they got the shorts on the hook and they're going to squeeze them. How do they squeeze them? By running buy programs. So you really don't have to think much deeper into it than that. It's just another tool in our arsenal. Don't let it overcomplicate things for you, because it doesn't need to be complicated. It's not complicated. So actually it would be silly to let it get complicated. And let's take it one step further, guys. If you feel like this is too much for you at this point, just take it off your screen for right now. You know, the newer members, I don't expect you to be trading at this point. And if it's too much to start thinking about the tick, that's fine. You know, bypass it for now. Concentrate on the zones. Concentrate on the inventory levels, transitions. Concentrate on the divergence. And forget about the tick. Put the tick on the back burner for another week or two. You know, wait for the next session when we go over tick again. That's up to you. So let's actually define the tick. You know, we watch it. We talked about what we're looking for. What is this actually showing us? Well, the NYSE, the New York Stock Exchange tick, is a measure of how many stocks are rising in price versus how many are declining in price. An upticking stock is one where the most recent change in price was positive. So in other words, if you're talking about a stock that just went from $20.06 to $20.07 per share, that's an upticking stock. That's going to show as a +1 in a tick. Right? A down-ticking stock is one where the most recent change in price was negative. So the actual tick is calculated by subtracting the number of down-ticking stocks from the number of upticking stocks. For example, a reading of 676, positive 676, means that there's 676 more upticking stocks than downticking stocks at this particular time. All right, and tick is recalculated continuously throughout the day. DTN, I forget. I need to research this a little bit better. They've keep improving it. I don't know if it's on a sub-second basis, but I'm pretty sure it's on at least a second basis where it's continuously being updated. I know it used to be every 6 seconds. Now, some of the other data services only update tick once a minute. Big difference. Right? So this is continuously moving, whereas there's data services out there that are only updating it once a minute. Wherever it is, if it closes here in 1 minute, boom. Next minute, they're going to show you where it is. Next minute, they're going to show you where it is, and they just connect it with a line. So it's a little misleading. If you look at it, it might look like it might be continuous, but it's not. Not as accurate. You know, we can't use that. All right, so when you see buy programs here, you very rarely see them go above here. It's kind of like when the market gets to this level, there's no more buying at that point in time, and the market lets off a little bit. I don't look into tick like that. Some people do. They look at this as being overbought. They look at this being oversold. I don't even like to make it that intricate or complex or anything, because I don't feel like it should be. I'm just watching the buy programs, sell programs to see where the pressure is. I got long in the market. I want to see some buy programs going off, at least some pressure to the buy side. That doesn't make sense to anybody, please let me know. one reason traders have problems with trading the ES and other equity index instruments like the ES, the NASDAQ, the NQs, the Russell, is because they're not paying attention to equities action. It provides a lot of clues. Just think about this: the buy and sell programs that are literally tugging the S&Ps around most of the day. You know, the large liquidity participants, the traders holding open interest in the S&P futures, have to constantly adjust and react to the equities action in the market. Most traders just they don't understand how to track it. And again, like everything else, they make it more complicated than it has to be. Another thing to think about is when equities action is dormant. In other words, you get those days where they can't even get above 600 or below minus 600. The S&Ps for the most part are going to be range bound. Going to be a perfect day for playing those zones, for playing little minor inventory transitions, because there's no equities action to push the market. There's no outside news. And think about this. If nothing changes from Tuesday, the close on Tuesday, to the open on Wednesday and throughout the day on Wednesday, if there's no new news, there's no equities buying or selling programs going off, then really what's going to push the market away from its previous day's range? Nothing. There's really not much that's going to take it out of that range. So yeah, they're going to push the edges to hit stops. But guess what? Once those stops get hit, the market comes right back down into the middle of the range because there's nothing really changed. When you get caught up and you're only trading on a really small time frame like most day traders are, they don't even have a clue of that perspective. But if nothing's changed from yesterday, the market's most intents and purposes, the market's going to stay range bound. Think about that. That's a good clue to have when you're trading. Whether you think the day has a higher degree of probability to be a trending one-way type of day or a range-bound day, ideally the range-bound type of days, that's our bread and butter. Those one-way type of trending days that don't happen too often, maybe 20% of the time. Yeah, we'll trade those days and we can make money on those days, but there's not as much opportunity on those days, are there on the days that the market is range-bound back and forth. And in fact, the only type of day you'll see me take a loss on will be a day where there's a one-way type of action day, but not only that, but an extreme type of one-way day. Like we had like maybe 3 weeks ago. I think our last losing day was about 3 weeks ago. Does that make sense, everybody? Any questions on that? So equities tick, the NYSE tick market, for the most part, equities will lead futures. Alright guys, another thing that we're going to talk about is the breadth. We haven't talked a lot about this. And it's called the advances versus decliners, basically. Advanced decline line. People refer to it as breadth. It's showing the underlying strength in the market. Another important clue, and it's not something I'm staring at every moment of the day, but I want to know the overall strength in the market. Okay, and thinking about the fact that for the most part, equities leads futures. So if breadth is shown, let's define breadth first. Okay, the advanced decline line. What we're doing here is graphing the difference between the number of advancing stocks and the number of declining stocks on the day. Okay, where tick is showing us on a per tick basis how many stocks are ticking up versus ticking down. Breadth is showing us what's occurring on the day. Okay, let me get that breadth chart back. Okay. Now, the advanced decline line is going to go up. The breadth is going to go up if that difference is positive. In other words, if there's a greater number of advancing stocks than there are declining stocks. So a rising breadth line indicates a bullish market, while a declining breadth line indicates a bearish market. And we're using the advanced decline line to evaluate short-term pressure in the market. Not over the last several days, really just the day itself, not even comparing it to yesterday. One day has nothing to do with the previous day. Right, but we're using this to validate what's occurring in the futures market, right? So if we see breadth popping up here in the morning and it doesn't trade overnight, like breadth and tick doesn't start giving us data until 9:30 when the equities market opens, but if we see a pop out of the open and breadth rallying and go positive 200, 300, 400 to the upside, and yet we see futures like sideways to down, maybe down 2, 3, 4 points on a day, that's a divergence, right? So for the majority of the time, we're going to be careful about selling that market, the S&Ps, because breadth is so strong. The underlying strength. When you hear me say underlying strength, that's what I'm referring to. I'm referring to breadth. So when the underlying strength in the market, in the cash market, is strong, you're going to look for strength to come into the futures market. And on its own, it's not enough to just say, hey, I want to get long the futures. No, it's just an additional confirming indicator. So now, if you see breadth pop into the upside and yet futures is going sideways to down, it's in a zone, you have a nice divergence to the buy side, things are setting up real nice for a long trade. Now you start to see some buy programs go off, breadth starts to head even higher, and now futures starts to tick up. You know the S&Ps are going to get a good pop there. Good reasoning to maybe hold on to part of your position for a little bit of a runner there. Makes sense, guys? On the same token, if the futures market is up a little bit, but yet advanced decline line is dropping out of bed, I mean really selling off hard, like we saw a couple of intense days last week and the week before, that's a clue. Be careful getting long that market. Be careful fading that market, right? If the market's selling off, I'm going to be that much more careful in stepping in front of that market because of that underlying weakness in the equities market as the market continues to push to the downside. Makes sense, guys? So now that we've talked about it, when I start to see something in the breath, I'll pull it onto the screen so we could look at it. For the newer students. I think several of the older students are looking at it. And in fact, I think I looked back on some of the text that was in the chat room, and Robbie and Shiva were talking about it, and I think Ralph maybe, who actually is a newer student but has a lot of experience. It's definitely a helpful clue. But again, not something that I'm sitting there staring at. It's not something that I'm paying too much attention to. It's really, I glance at it initially and I get all the information I need to know from it, Any questions on breath or tick, guys? Any questions on any of, we didn't get to do a market review Sunday Night Edge because of the hurricane. Any questions on anything having to do with the methodology, on Sierra charts, anything? Any questions at all, just throw them out there. What we're going to do tomorrow is I want to do a good review on our 4 steps here. Make sure these are all making sense. And then what we're going to do tomorrow is start to put some of these together, our 4 pieces of information of confirmation together with actual trade entry setups, what we can use to actually get us into some trades. So tomorrow's going to be session 6. And we'll get together tomorrow again at 3:30. Does anybody not have these 4 steps? The 4 steps in objectively quantifying the order flow and supply and demand imbalance? It's up on the site under the toolbox. It's one of the PDF documents that we have up there. And I don't think I ever got a chance. I think I had meant to do it over the weekend to put up the a little bit of a review on the order flow with some of those important points that we made in talking about order flow and inventory transition, those 3 steps, the divergence. So we'll put that up on the site tonight as well. Alright guys, if there's no questions, we're going to call it a session here. I will be away from the screens for a bit. I will be back in front of the screens later tonight. In the face of the inventory transition that occurred on the close here, gonna look for some longs setting up here later on tonight when I get back. If not in this area here, if any additional weakness comes in, then lower closer to this inventory level, if any of these guys can start to get squeezed out. As and if we're near a zone at that point. Here's another minor level. This is more of a minor level, guys. This is the more important level here. Let me put my breath back up on. Jay has a question. You have IQ feed and the charts display all of the zones on the 60-minute. Is that normal to have the zones preloaded? You mean the zones that I created? And you opened up the chart book and those zones were on there? Jay? Just want to make sure I'm following you before. Okay. Yeah, if you have any green zones on there, that's just the zones that were on there when I created the chart book. When I save it, it saves whatever zones I have on there at the time. So what I would recommend you do is when you have the chart open that you want to erase the zones on, just be careful, make sure you're on that chart. Go to Tools, Erase All Lines right here. Just be careful, because if you do that, if you've written anything on there that you don't want to be erased, it's going to be erased. It's going to erase everything only on that chart. Erase all lines. You know, what I recommend also for some of the newer students, if you have a chart that you're really trying to keep nice and neat as you go along, and take your zones off as they're breached and update them and keep them according to what I have, how I have my zones, but yet you also want to practice, just duplicate the chart. Alright, so go to the chart that you want to duplicate and just go to Charts, Chart, Duplicate Chart, and it will actually duplicate that chart, so you can have one as a practice where you can play around with and not worry about messing up your other zones. And then it will show up over here. Actually, I have a few up here for practice that I'm actually going to get rid of, but if you're done with it, you don't need it anymore, just get rid of it. Just go to X, remove chart window. Yes. I'm going to actually get rid of a couple here that I didn't even realize I had on here. Don't need that. And you see them disappear up here. And that's that, guys. Is that chart a 1 hour? The profile chart is a 60-minute 1 hour chart. We do have a daily chart that we look at as well, but we really haven't gotten into that yet. But same thing, it's a daily profile. Doesn't really come into play as much with the day trading. There's certain aspects of the daily profile that we can take heed and notice. But for the most part, everything that we're doing is based on those 60-minute charts. Yeah, it says 1 minute. That's just the data. That's how it takes in the data. That's how it's creating the information. But don't pay attention to it. It's a 60-minute chart. Alright, guys. Good session. Good day. Good day for me to get back in the saddle. Get back into the rhythm of things. We're going to go at it again tomorrow. Rest up. Relax. Refresh. And we'll do it all again tomorrow, guys. Have a great night. We'll have this video up on the site a little bit later this evening. You're welcome, guys. Have a great night.